Gold's headline price is lying and the spread is telling the truth, and the quiet squeeze isn't coming from a meme at S coming from Europe. S funding plumbing, getting tight enough that paper gold can to pretend it. It's the same thing as metal in your hand. Everyone wants to argue about one viral number. Physical gold at $2, $9.87, while the professionals are staring at a different question. When you actually try to source real bars and real size on real deadlines, does the market clear without paying up? Because if it doesn't, the next move isn't an opinion, it's math. And by the end of this video, you'll have 3 things you can use immediately. The one hidden detail most people miss, the calendar trigger that turns small stress into big price action, and a next week checklist, levels, confirmations, invalidations, so you're not trading vibes when volatility starts trying to shake you out. Now, let's deal with the $2,187 print right away, because it's the perfect example of how investors get manipulated without anyone lying not to them. Physical gold can mean a local dealer, quote, a specific bar type, a specific VAT situation, a specific settlement speed, a specific currency conversion, a stale screenshot, or a price that includes premiums and logistics. Meanwhile, gold price on your screen is usually a spot reference that assumes wholesale settlement in the world, S deepest venues. Those are not the same product when liquidity is normal, and they are definitely not the same product when liquidity is stressed. That's the conflict. One side of the market wants you fixated on the cleanest number, the simplest chart, the neatest narrative. The other side, the side that actually has to deliver metal or hedge risk, is watching the messy layers where stress shows up first. And that's where the pressure starts. So let S anchor ourselves in what we can see without worshiping any one screenshot. Gold has started 2026 with a level of speed and persistence that doesn't look like a sleepy, safe haven drift. It's been pushing, pulling back shallowly and snapping back. Exactly what you see when liquidity thins and every dip gets met by a buyer who isn't too pricing sensitive. In early January, spot has been hovering in the mid-4,000s, flirting with the late December peak around the mid-4,500s, and the week has been punctuated by sharp bursts tied to macro catalysts and risk headlines. And that matters because it tells you the market is not relaxed, it's braced. And when a market is braced, the next detail is what flips the whole setup, the curve, not the headline, the curve. Here's the hidden detail, and I'm going to make it plain. In a healthy gold market, you expect the difference between now and later to behave like a boring function of funding costs and convenience yields. In stress, that relationship breaks. You start seeing the forward market and the swap market behave like they're rationing balance sheet. You see the basis behave like it's negotiating with reality, and you see little premiums pop up in places retail never looks. EFP-type dislocations, unusual roll behavior, odd tightness around certain delivery windows, and a street that suddenly cares a lot about where the bars are not just what the screen says. That doesn't mean guaranteed moonshots. It means the market is admitting there is a difference between owning a claim and owning the thing. And once that difference gets priced, it's hard to unsee, but that's not the part that matters most. The part that matters is why it's happening right now, this week, this month. Because markets can carry hidden stress for a long time, and then a calendar date forces everyone to reconcile it at once. January is a reset month. New collateral needs, new risk limits, new balance sheets, new hedge rolls. Liquidity is often thinner than people expect because participants are reallocating and remargining. And in metal specifically, the calendar matters because delivery windows, option expiries, futures rolls, and financing terms collide. When you hear the calendar is the catalyst, don't think astrology. Think operational deadlines. Think, if a dealer is short physical, they can skate for a while with paper hedges until a delivery date arrives. If a bank has balance sheet constraints, they can quote wide and step back until client flows force them to intermediate anyway. If a fund is running exposure through futures, they can hold until roll mechanics and margin changes nudge them to lighten up or pay up. That is why a market can look calm on a chart and still be under a rising internal pressure. And if one level breaks, the math changes. So let's explain the mechanism in a way you can actually use. Gold has multiple layers of price discovery. Spot references are huge, futures are huge, OTC forwards are huge. But physical, actual bars moves through a supply chain with friction. Refining capacity, bar size conversions, custody requirements, transport, insurance, and the simple fact that not every bar is good delivery for every venue. When everything is calm, arbitrage keeps these prices in line. If spot is cheaper than physical, dealers buy spot exposure, source metal, deliver into the chain, and capture the difference. If physical is cheaper, the flow reverses. That's the theory. In practice, arbitrage requires balance sheet, financing, and the ability to move metal on time. When funding tightens or balance sheet becomes expensive, the arbitrage link weakens. And that when you can see paper price looks stable, while physical reality starts whispering a different story through premiums and curve behavior. But here it's the twist. The market doesn't need a total breakdown for this to matter. It only needs enough friction that marginal supply can't show up instantly. Because price is set at the margin, and the margin is where stress lives. Now connect that to Europe. Europe's financial system is built on collateral and repo plumbing. When central bank liquidity is abundant, this plumbing is forgiving. When excess liquidity is draining and regulatory and structural changes push the repo ecosystem into a new phase, the system becomes less forgiving. Small funding stresses matter more. Cross-currency funding matters more. The cost of carrying inventory matters more. And gold, because it is both a monetary asset and a tradable commodity, sits right in the middle of that intersection. If your funding cost rises, your ability to warehouse metal cheaply declines. If your balance sheet capacity tightens, your willingness to run arbitrage lines declines. And when that happens, the spread, not the headline, starts telling you what the real market is doing. But that's still abstract, so let's stack proof in a way that feels like you can touch it. Proof point 1, the term structure signal. Watch how the market treats now versus later. In calm times, the forward curve behaves predictably. In stress, you see hints of tightness in nearby tenors and weirdness around roll windows. You might not have the full institutional screens, but you can still infer it from how futures behave into delivery months, how quick dips get bought, and how the market reacts to margin changes. Remember that last week, S margin adjustments in futures were enough to force a temporary dip, and then demand snapped back. That's not a random bounce. That's the market telling you there's a buyer underneath who sees dips as opportunity, not warning. Proof point 2, inventories that count versus inventories that look big. In metals, the difference between inventory exists and inventory can be delivered into the contract or the venue that matters is everything. There are categories of stock that are eligible but not registered, deliverable but not mobilized, vaulted but committed, present but not in the right bar size. The headlines love a single number. Professionals ask, what is actually free to move? Because when the market needs immediate metal, only that slice matters. And when that slice gets tight, spreads can move faster than spot. Proof point 3, the behavior of the largest, least emotional buyer. The one that doesn't care about your perfect entry. Central banks. This has been a defining feature of the gold market in recent years, and it matters even more when volatility tries to fake you out. A central bank buying program doesn't react to your intraday candle. It reacts to reserve strategy, currency risk, sanction risk, and long cycle trust. That's why dips can feel unnaturally supported. It's not magic. It's a structurally different demand function. Proof point 4, ETF and ETP plumbing. Retail treats ETF flows like sentiment, but ETFs are mechanical pipelines. When big money wants exposure, creation units get built, and that can pull metal into a financial wrapper that sits in custody. When flows reverse, redemptions can release metal back out. But the timing, the participants, and the friction matter. In a tightening funding environment, the authorized participants who make these markets care deeply about balance sheet and financing. That affects how tight they quote, how willing they are to intermediate, and how quickly the system can absorb demand shocks. Proof point 5, macro drivers that hit gold through plumbing, not poetry. Rates, inflation expectations, currency stress, cross-currency funding costs. When the cost of money shifts, gold's opportunity cost shifts, yes, but more importantly, the carrying and hedging ecosystem shifts. A market can be bullish on gold because it expects easier policy, but it can also be bullish because it senses instability in funding markets where collateral is king. Europe is the place to watch because the euro area liquidity environment is evolving as the central bank footprint changes and markets adapt. You don't need a Hollywood liquidity crisis headline for that to matter. You just need the marginal dealer to feel less willing to warehouse risk, because then the market gets jumpier, and jumpy markets gap. Now, let us talk about the title S characters, Deutsche Bank silent, and Credit Suisse flipped long. Here's how you handle this like a professional and not like a headline addict. First, banks don't broadcast their positioning in real time. What you often see is the absence of commentary, the tone shift, the carefully worded note, or the change in how they quote risk to clients. Silence can mean many things. They're managing client flows, they're protecting a franchise, they're constrained by internal risk limits, or they simply don't want a public call to become a trade crowded against them. That's not conspiracy. That's incentives. Second, Credit Suisse flipped long in 2026 should be understood as legacy Credit Suisse risk books and client franchises, now within a larger bank ecosystem, may have changed exposure. After the merger events of recent years, the name itself can be shorthand in market chatter for a lineage of books, relationships, and positions that still echo through the system. Could a major bank's derivatives desk shift from net short gamma to net long exposure? Absolutely. Could a bank reduce hedges because client demand has changed? Absolutely. But you cannot build a thesis on a rumor. So what do? You translate the rumor into a mechanism you can actually test. If a major dealer complex is flipping long, it would show up indirectly as changes in how dips behave, how volatility is offered or bid, how option strikes act like magnets or launch pads, and how the market responds to stress events. And that's where the real pressure starts, because if dealers are short gamma and the market rises, they have to buy more as it rises to hedge, forced buying. That's reflexivity. If they're long gamma, they dampen moves, selling into rallies and buying into dips. So one practical question for next week is, do rallies accelerate as certain levels break, or do they get smoothly absorbed? Do dips instantly snap back, or do they grind lower? This isn't fortune telling. It's observing market structure. And now we can connect it back to gold in a way that makes your next decisions cleaner. Gold can rise for two very different reasons. One is an emotion narrative reason, fear. The other is a math reason, positioning and plumbing. In the math reason, gold rises because the market is forced to reprice the cost of carrying and delivering risk. That's when you get persistent strength even when headlines are mixed. And that's exactly why the opening claim matters. This move isn't emotion, it's math. But don't get cocky, because this is where people get hurt. Gold can drop violently even when the thesis is correct. A sudden dollar squeeze, a risk-on melt-up, a margin hike, a sharp rates move, any of these can trigger liquidation. The market doesn't ask if you're right, it asks if you can hold. That's why risk management isn't a disclaimer, it's the whole game. And that's not the part that matters most either. What matters most is having a two-scenario lens so you're not emotionally hijacked by the first ugly candle. Scenario 1 is the controlled pullback and retest. In this scenario, gold cools off, tests prior breakout zones, shakes out weak hands, and then resumes higher if the underlying plumbing stays tight. This is where you see the market reload. Dips feel heavy for a day or two, then bids show up at predictable zones. The curve steadies. Premiums don't collapse. Scenario 2 is the continuation squeeze. This is the gap risk scenario. Liquidity thins, a catalyst hits, geopolitical, policy, funding, and price jumps through levels where stops and dealer hedges trigger forced buying. In this scenario, you don't get the clean retest. You get air pockets, then snap-ups, and anyone waiting for the perfect entry gets left watching. Both scenarios can happen within the same month. Your job is not to predict perfectly. Your job is to recognize which one is unfolding and manage risk accordingly. Now let's talk levels, because levels are not magic lines. They're where participants are forced to act. Start with the late December peak area in the mid 4500s. That zone matters because it's where sellers previously proved they could defend and where a break can turn sellers into hedgers. When a market breaks a recent peak, two things happen. Shorts feel pain, and dealers who sold upside calls start chasing deltas. That's the reflexive fuel. Below that, the low 4400s and the early January base area around the low to mid $4,300 matter, because that's where the market began the year and where you can distinguish trend from noise. If price can't hold those zones on pullbacks, the bullish structure weakens. If it holds them and rebounds quickly, it confirms that dips are being absorbed by real demand and hedging mechanics. And here's the one level that changes the math: the reclaim and hold above the prior high zone on a weekly basis. Intraday spikes are noise bait. The weekly close is the audit, because funds and risk managers mark the world on closes. If gold can keep printing higher closes without giving back the breakout, it forces allocators to chase, not because they want to, but because underperformance is career risk. That's when flows become a driver, not just a follower. But there's an even more important tell than the close: the behavior of spreads and the street. You want to know if the physical tension story has teeth? Watch for symptoms. Dealers quoting wider, retail availability tightening, delivery times lengthening, premiums staying elevated even when spot dips, the curve refusing to relax. These are the on-the-ground signs that the market is tighter than the headline suggests. And if you see them persist, the setup stays alive. If they vanish quickly, premiums collapse, delivery normalizes, curve relaxes, that's your warning that the stress was temporary. Because if this one detail flips, the whole setup changes. Now, I want to address the Europe liquidity angle with the seriousness it deserves without turning it into a cartoon. The phrase liquidity crisis gets abused. What we're really talking about is a continuum from abundant reserves and easy balance sheet to tighter reserves, more expensive balance sheet, and a repo ecosystem that has to adapt. Europe's repo and collateral system has been evolving under regulatory change, central bank footprint changes, and the slow migration toward more central clearing in certain segments. When the system is adapting, it can handle normal days fine and still be fragile on stressed days. And gold tends to feel that fragility because it is a globally used collateral-like asset in certain contexts. and because the bullion and derivatives ecosystem relies on smooth funding and smooth intermediation. When that smoothness deteriorates, the market can become discontinuous. That's the real risk, discontinuity, not a slow grind, a gap. And that's why, even if you love the bullish thesis, you respect volatility. Because volatility is how the market transfers conviction from the impatient to the patient. Here's your viewer psychology shield, and you need it, because if you're finance-minded and skeptical, you're still human, and the market knows exactly how to play your nervous system. First tactic, the violent flush. Price drops hard, fast, on a headline that sounds rational. Margin changes, rates spike, risk off is over, whatever. The goal is to make you feel stupid for being long, so you sell into weakness. Second tactic, the relief pop. Price bounces and you feel regret. Then the market chops sideways just long enough to convince you the move is done. Then it runs again without you. Third tactic, the expert chorus. You'll hear confident voices telling you gold is either guaranteed to explode or guaranteed to collapse. Both are designed to hijack your decision making. The antidote is mechanical. Decide your time frame, decide your invalidation, decide your size. Trend signal versus noise. A trend signal is a structural pattern. Higher highs and higher lows, persistent bid, spreads refusing to relax, pullbacks being bought. Noise is everything else. The intraday tantrums, the 1 hour panic, the social media screenshot war. If your thesis is built on plumbing and positioning, you don't let a one-day headline rewrite it. You let the market prove or disprove it at your defined levels. That the discipline that institutions pretend to have and retail can actually execute if they stop trying to win every candle. Now, let's pull the camera back and connect the geopolitical piece, because it matters this week. Gold has been responding to real-world catalysts, and early January has already delivered enough headline risk to remind everyone that stable is not guaranteed. When geopolitical stress rises, gold gets the first bid because it's the simplest hedge people understand. But the deeper bid, the one that sustains, comes when the hedge becomes a reallocation. When portfolios start treating gold not as a panic button, but as a structural ballast. That's when demand becomes sticky, and that's when dips get shallow. But the next detail is what flips the whole setup. If gold is rising, while certain funding stress measures also worsen, you're not just seeing fear. You're seeing a pricing of collateral scarcity and balance sheet cost. And that why the Deutsche Bank silent Trump high vibe fits the narrative even without any dramatic confession. Big institutions dawn to like to talk loudly when plumbing is the story, because plumbing is where systemic risk hides. They'll publish outlooks, they'll discuss macro themes, but when the real issue is the cost of intermediation, the public language gets careful. So what comes next, specifically in the next week or two? Here's the roadmap you can actually use. First, watch whether gold can sustain above the recent breakout attempt zones without giving back the gains in a single ugly reversal. If you see a sharp sell-off that immediately gets bought and fails to follow through lower, that's a sign the bid is structural. If you see sell-offs that start to cascade, lower lows, weaker bounces, that's the market telling you the pressure is releasing. Second, watch the behavior around the prior peak area in the mid-4500s. Clean breaks with acceleration suggest reflexivity. Stops and hedges kicking in, rejections and quick fades suggest the market still needs to digest and may retest lower supports. Third, watch the dollar and rates, not because you're trading Forex, but because they set the carry and the stress regime. A sudden dollar squeeze can punish gold even if the longer thesis holds. Fourth, watch funding and collateral chatter. Repo tone, cross-currency basis discussion, anything that signals balance sheet is getting scarce. You don't need perfect data, you need the direction of stress. Fifth, watch real-world symptoms, premiums, availability, delivery times, and the street's willingness to quote. If those symptoms intensify while spot holds firm, the setup strengthens. If they fade, the setup cools. Now let's be brutally honest about the counterpoints, because credibility comes from naming what can break your story. Counterpoint 1. A sharp improvement in risk appetite combined with a strong dollar can drain marginal demand from gold, especially if people rotate into high beta. Counterpoint 2. Policy surprises. If markets suddenly reprice rates higher or lower faster than expected, gold can whipsaw as real rates expectations shift. Counterpoint 3. Forced liquidation. Even in a bull market, margin events can create air pockets. Counterpoint 4. The physical premium story can be localized and temporary, driven by a dealer inventory issue, a tax change, a shipping bottleneck that resolves. If you anchor on one premium print, you can get fooled. That's why you're watching persistence in spreads, not a single number. And that guess why the viral $1,000, 987. Physical eye line is useful mainly as a teaching moment. It shows you how easily the crowd can be steered by a simple number while the real story is in the messy mechanics. But here's the bullish core stripped of hype. Gold has structural buyers. Gold has a macro environment that can support it if rates ease or if uncertainty persists. And gold has a market structure that can become reflexive when levels break and dealers have to hedge. Add in a Europe funding environment that is transitioning and occasionally fragile, and you have the ingredients for continued upside pressure punctuated by violent shakeouts. That's not a promise. That's a setup. And setups pay only if you manage risk. So here's the practical don't get played framework. If you're bullish, don't anchor your confidence to your entry price. Anchor it to your invalidation. If the market breaks the structure, fails key supports, spreads relax, premiums evaporate, the bid disappears, then you reassess. If the market holds structure through volatility, you respect the trend. And if you're skeptical, don't dismiss the move because the headline number seems weird or because you done tea like the narrative crowd. Skepticism should make you more precise, not more stubborn. Look where the stress shows up. Look at the curve. Look at behavior around delivery windows and option strikes. Look at whether dips get absorbed. That's the difference between being a skeptic and being a contrarian for entertainment. Now let's close this in the most useful way possible. 2 scenarios, targets, invalidation, and a next week checklist. Without the begging CTA, just the identity call. Scenario 1, controlled pullback and retest. Gold cools, drifts back toward early January base zones, tests support, and then resumes higher if the bid remains. In this scenario, your confirmation is higher lows and quick reclaim after dips, with spreads and physical symptoms staying firm. Your invalidation is a decisive break of the base structure with follow-through and a visible relaxation of tightness signals. Scenario 2, continuation squeeze and gap risk. Gold holds firm near highs, liquidity thins, a catalyst hits, and price pushes through the prior peak area with speed. In this scenario, your confirmation is acceleration through resistance, rising volatility with upside dominance, and shallow pullbacks that fail to break structure. Your invalidation is a breakout that instantly reverses and closes weak, especially on a weekly basis, suggesting it was a liquidity pop, not a structural repricing. And here is the next week checklist in plain language. Watch the weekly close relative to the prior peak zone. Watch whether pullbacks are bought within hours or bleed for days. Watch the dollar and front-end rate expectations for sudden shocks. Watch for any signs that balance sheet is getting scarce in Europe's funding plumbing. And watch real-world physical symptoms, premiums, availability, and dealer behavior for persistence. If those items align, the thesis strengthens. If they don't, you don't argue with the tape. You adapt. Because the goal isn't to be right on the internet. The goal is to survive the volatility long enough to let the thesis work and to exit cleanly if it doesn't. If you read the kind of investor who wants mechanisms over narratives, who wants to know what forces participants to do, not what commentators want you to feel, then you're already in the right crowd. Stay with the people who watch spreads, structure, and incentives, ignore the screenshot wars, and remember, when the spread starts yelling, the headline eventually catches up.